What if I told you that last tax year, UK savers paid over £6 billion on their interest savings? But then on top of that, HMRC, they expect that figure only to rise. And then you've got with the new budget, some kind of new increased tax rate on savings income. It's not looking good because that's a lot of money going down the drain. And that's why in this video, I'm going to show you 5 ways that you can end up lowering or completely getting rid of the tax bill that's due on the interest from your savings. So if you're new here, my name's Ross. I'm a diploma holder in regulated financial planning. On this channel, I help inform you on ways that you can help build wealth, protect it, and then enjoy it as well. This video, it's part 2 in a series that I'm covering all the major tax types. And as you can tell by the video, this one's on savings interest and how to get that bill down. But if you'd like to also know about the other types of tax and how you might be able to lower the bills on them as well, be sure to subscribe to the channel to be notified when them videos end up coming out. And yeah, with that, let's just get right into it. So a bit of background first. HMRC release reports every year, basically breaking down the stats of taxes paid, who's paying them, how much is being paid. Boring! The stats that are important for this video is that last tax year, HMRC ended up bringing in over £6 billion from taxes that were due on interest from savings. And when you compare that to the 2021-2022 tax bill, that's 6 times more than they were collecting back then. Despite this figure already having a massive increase, HMRC do predict that it will continue to grow moving into the future. Now there's a lot of reasons for this large increase in the amount of money that HMRC are getting, probably the most primary of which was being back in 2021-2022, coming out of the pandemic, interest rates were really, really low. And well, inflation hadn't quite hit yet. So as such, government's trying to get people out and spending more money. But now obviously interest rates have gone up steeply since then. And as such, people are earning more money from any savings that they have in the bank. And as such, they're not realizing that that money that they're earning is now due to be taxed. So next up, lastly, before going into the 5 specific methods, I'm going to cover quickly how the tax on interest works so that you understand what's happening. So first, you may or may not know that you have your personal allowance, £12,570 of income that you can earn completely tax-free. So on top of your personal allowance, you also have something called the personal savings allowance. And this pertains specifically to interest and interest on savings. So if your income is under the personal allowance, then that means you have a personal savings allowance of £5,000. And that means you can earn £5,000 from your interest and not have any tax due on it. Now, it gets a little tricky after this point because once you start earning above the personal allowance, for every £1 you earn above the personal allowance, you lose £1 of your personal savings allowance. So to use an example to illustrate this, if you earn £16,000, you don't have the full £5,000 personal savings allowance because you're earning above the personal allowance. So all you do to work it out is you just take the £16,000 and then you can take away your personal savings allowance of £12,570, and then that amount that's residual, you then take that away from £5,000 and that leaves you with how much you can earn from your interest without paying any tax. So earning £16,000, you would be a difference of £3,430, which means you would have £1,570 left for your personal savings allowance, meaning you could earn that amount from your interest without needing to pay any tax. This continues until you get down to having £1,000 left in your personal savings allowance. As a basic rate taxpayer, if you're one of those, then you have £1,000 in your personal savings allowance. So if you earn anything in the basic rate tax bracket that's above that amount that tapers down your allowance, then you still have £1,000 that you can earn from interest completely tax-free. Once you get to being a higher rate taxpayer, that £1,000 gets lowered to £500. So you have £500 you can earn from interest without paying any tax. And then if you're above that, if you're an additional rate taxpayer, you have none. So hard lines. So now that you hopefully have an understanding of how tax on interest works, we can move on to the 5 ways that you can use to end up paying little or hopefully no tax on your interest savings. And we'll start off with the easiest and arguably a bit of a cheap one is, well, simply don't earn enough interest on your savings to have a tax bill due. Now, I know this sounds, well, a bit obvious, but it's an important thing to really consider because cash shouldn't be held as a long-term investment. The fact of the matter is that cash grows historically lower than the rate of inflation. So if you're holding cash over a long period of time, your purchasing power is only going to go down, and you're effectively losing money in the long term by holding large quantities of cash, not to mention that you end up paying tax on it as well. Now, don't get me wrong, there is situations that you obviously want to have cash for. If you're planning on making a purchase in the short term, whether that's you're looking to buy a house in the next year or something like that, holding cash for that, for the deposit, probably is a wise move to end up avoiding any market volatility. And not to mention also having your emergency fund in cash so that when the emergency eventually happens, as it will happen to everyone at some point in their life, it's there ready to go, no problems. You're able to get into it right away. So for those types of situations, having cash is important. But when it comes to long-term saving for stuff like retirement, holding it in cash is just not an efficient way to do it. Another way you can look at it is if you're holding cash in a bank account that's paying it, let's say 4% interest rate, there's other ways that you can use it more effectively out with stuff like investing in the stock market. But it could also be used to pay down maybe debts that you have. If you have debts that are higher than the 4% interest, instead of holding onto that cash, again, out with having an emergency fund saved, paying that down is going to be a more effective use of the cash as opposed to just holding it in the bank and letting interest accrue and then also be taxed. The new budget from Labour has attempted to address this, at least haphazardly, by lowering the cash ISA limit so that you can only put in 12,000 instead of the normal 20,000. That's coming in 2027, which they've got the right idea but maybe the wrong approach, as people just need to be informed that holding that much cash in the long term just isn't an efficient way to do things. If you're paying tax on your interest, is that actually needed? Is this just an emergency fund that's covering maybe 6 to 12 months type of thing? Or am I holding way more than that? And maybe consider speaking to professionals about how to better allocate these funds.
Hi guys!
Jump scare. Next up, we've got a slightly less cheap method of paying less tax on your interest, and it's premium bonds. Premium bonds is debt that's issued by the government. So in terms of safety, you don't really get much better, as if the government's unable to pay you back, then there's probably other problems going on in the world that are a bigger issue. And you can also put up to a maximum of £50,000 into them for yourself, which for most people is a more than adequate emergency fund. Now, I should say, before I get people in the comments attempting to correct me, technically there's not an interest rate paid on it. It's a lottery system, so the more money you own, basically you have tickets in it, and any winnings that you get from it is paid out to the bondholders. But effectively, it is an interest payment that's coming out. Depending on how much you own on the long term, kind of is a better indicator of how much interest you're going to end up getting from them. But for all intents and purposes, you're basically getting interest payments from them. But these payments are tax-free. The winnings from them are tax-free. Now, obviously, I would never encourage gambling or lottery systems as a secure way to get wealth, but if it's a good way to park your money in a tax-free way for stuff like an emergency fund, and then also you do have the chance of winning some of the prizes that are north of $1 million. And if you do that, well, it's tax-free, so that's always nice. But don't do it thinking that you're going to win the million, obviously. The next method on how to reduce the tax on your interest payments is fully utilising your ISAs. Now, currently the cash ISA limit is £20,000 a year. As previously mentioned in the video, this is going to be lowered to £12,000 a year in 2027. And basically, when you put this money into these wrappers, all the interest that's earned from it is completely tax-free. Cash ISAs, again, they're a really simple, straightforward way that you can get less tax being due on your interest payments. And them in combination with premium bonds, for most people, are more than adequate for covering all the reasons you would need to have cash on hand, whether again that's short-term purchases or an emergency fund that's on standby. Normally, these two in combination are right for most people. A quick tip on ISAs is that if they're available from where you normally get your ISAs, trying to even get yourself a flexible ISA, as they're more or less strictly an upgrade on normal ISAs. Normal ISAs are very strict on how much money you can put into them. Obviously, normally it's the £20,000 a year. So even if you take out money that year, you could still only put in 20,000 max. But that's not the case with flexible ISAs. Flexible ISAs allow you to put in any money that you've taken out in addition to the normal limit. So if you put in £20,000 into an ISA, say at the start of the tax year, but then an emergency happens later in the year and you need to quickly withdraw 10,000 from it, you can then put that same 10,000 back into an ISA as long as it's still within the same tax year. So it's just a wee bit more maneuverability and ability to pay off debts, but then also get back into a tax advantaged situation. Next up on the block for lowering the tax bill, we've got pensions. Similar to ISAs, they're a tax advantaged account. And while most people don't necessarily think you can put just cash into pensions, there's cash-like instruments that can be used to more or less mimic cash. In your pensions, money can be invested in stuff like money market funds, which very safe, very low, I would say risk, but that's a whole other, very low volatility. There's a difference. I do plan on making a video eventually clearing up the two, but it's much lower volatility in these money market funds. And most of the time, they do end up offering a better rate than your standard bank current account. Unlike the ISA, the pension limit is 60,000 a year. And there's also carry forward allowances on top of that. I won't go into that, but you have a much bigger allowance for how much money you can put into a pension each year compared to an ISA. And like an ISA as well, the interest growth on it is completely tax-free as well. Now, the obvious downside with this is that the money in the pension can't be accessed until you reach your retirement age, which is 10 years before the state pension age. So if you're putting money into there and you're under that age, well, you're not going to be seeing it for a while. And again, I would like to harken back to the point that over the long term, having stuff held in cash or cash-like instruments when it comes to stuff like planning for retirement is frankly a risky endeavour, as it will likely, best case scenario, keep pace with inflation more times than not, and as such losing purchasing power and effectively ending up worse off by the end of it. So please do bear that in mind when you're thinking about these types of things, especially when deciding how to allocate your pensions. Now, the last point I'm going to cover actually somewhat links to all the previous ones as well, and that's to make sure that if you're in a couple, a married relationship or a civil partnership, be sure to use both partners' full allowances when it comes to your tax-free savings. When it comes to people in relationships and civil partnerships or marriages, they have a special exemption that the assets can be moved between the two parties completely tax-free. And as such, you're able to move stuff about so that you can end up lowering your tax bill a lot of the time. This might mean that if one partner's fully used their ISA allowance, then maybe switch some of the assets over so that the other partner can then use their full ISA allowance as well. Same with pension contributions. And then of course, premium bonds as well. And then it also goes for the stuff like the personal savings allowance. So if you've maybe got a basic rate taxpayer and then one of you is also a higher rate taxpayer, then obviously one of you has the £500 limit and then one of you has the £1,000 limit. So if you have money in current accounts that maybe the higher rate taxpayer has that's ended up accruing a tax bill because the interest is over, then you could transfer that money to your partner who has the higher allowance for their personal savings. And as such, you still have the money between the both of you, but just there's less tax being paid, as now it's with the person who has a higher personal savings allowance. This is the method that I probably think least people even consider or know about. But the fact of the matter is, you both have allowances to use. So if one of you is fully using it and paying tax and the other one isn't fully using theirs yet, then it only makes sense to then get that moved over and balance it out and lower the tax as a result. Obviously, you need to be in a relationship. So if you're single, then hard luck, this tip's not really for you. But if you're in that marriage, civil partnership, then you're able to make the most out of both the allowances as best you can. And that can end up saving a lot of money, as much as all the previous tax advantage wrappers as well. So with these points, it should be clear that if you're paying tax on your interest, the likelihood is you probably shouldn't be. There is more than enough methods to get that tax bill down. Not to mention that the reason that you're holding that much cash in the first place better be a good one, because the likelihood is your money could be spent in much better places aside from, well, sat in a bank's vault. If you found the video useful, be sure to drop a like. It really does help the channel out. And do leave a comment as well. I'm interested to hear what you guys think about all this, and then also any video ideas or any topics in finance, retirement planning that you'd like to see covered, as I would like to help, and I'm curious what people might be confused about when it comes to their finances. But as I said, this is part 2 of a series. My most recent video, that covered inheritance tax and how to get that billed in. So if that sounds useful, be sure to check that out. And if not, until next time.